Why are annuities considered bad investments? Annuities provide a guaranteed income during retirement. Despite the benefits they offer, they are overall a poor investment choice for several reasons that we will explore today. Finally, at the end of the video, I will offer alternatives to annuities and the best approach to do an annuity if that's really the best choice or the preferable choice for you and your financial situation. If you're not staying for the entire video, let me warn you the high commission salespeople earn on annuity products. Do not allow a salesperson to do what is in their best interest, earning a high commission by selling you a financial product that may not make any sense for your financial situation. Annuities, they're intended to alleviate the fear of a retiree outliving their assets. After all, people are living longer and many people will outlive their savings. Many of us will unfortunately find out that our assets are not adequate to maintain our standard of living throughout our retirement. Therefore, annuities are particularly attractive for people that believe they will have long lives and risk outliving their assets. Therefore, annuities are a way to hedge against longevity risk, that is, the longevity of your own life. They provide a steady stream of income over a specified period of time or the lifetime of the person who purchased the annuity. They can supplement retirement income by creating predictable cash flow. They are considered a type of insurance contract. So the first stage of an annuity is called the accumulation phase. The investor would purchase an annuity with either a lump sum payment or monthly premiums. Payments would commence during the annuitization period, the payments to the investor, to the annuitant, and they would continue for either a fixed period of time or for the rest of the life of the annuitant. There are two types of annuities, immediate or deferred. Immediate annuities are purchased by people of any age that want to exchange a lump sum of money for cash flows in the future. So this is going to be somebody that like won a lottery, won a huge lawsuit. Maybe you inherited a lot of money. If you suddenly come into a lot of money and maybe you don't trust yourself or you want some structure, well, then you can do immediate annuities. So immediate annuities are when you're immediately trading a lump sum of cash for future cash flows. And then you have something called a deferred annuity, which is the other kind. This is going to refer to a delay in when you will receive the cash payments. So, you might make a lump sum payment now or those monthly premiums. You might be making those payments over time, but it's going to be some time before you start getting cash payments from the financial or insurance company that you bought this annuity from, and that's what the deferred annuity is. Also, the annuities can be either classified as fixed or variable. So a fixed annuity is going to pay a specific rate of return on what you invest. In contrast, the variable annuity it's going to invest the money probably in like the stock market and mutual funds, something like that, and those returns are going to fluctuate, so you might not exactly know what those returns will be with the variable annuity. So the con that most people are going to focus on and that I'm going to warn you the most about is the high commissions. A financial advisor could make 6% to 8% or more, even more than 8% from selling an annuity versus maybe they'll make 2% on a mutual fund. So, just think about it from their perspective. You can make 2% or you can make 6% or 8%. So it's obvious what they're going to try and steer you towards. So if we're talking about $500,000, well, the commission for a mutual fund would be about $10,000, but then for the annuity it's $25,000. It could be $35,000. It could be more than $35,000. So therefore, it is in the financial advisor's best interest to direct as many clients as possible into annuities because the commission is 2 or 3 times or more than that greater than for a mutual fund. Annuities have high fees that are not apparent at first. There are annual maintenance and operational charges that are considerably higher than that for mutual funds. There's been a lot of public backlash against these exorbitant fees. I call them exorbitant. I think they're exorbitant. Maybe you disagree. Many insurers are having to reduce these expenses. However, the low expenses are not a given, so you shouldn't assume that the expenses are going to be low or reasonable. So it's something that you should review before you commit to a financial product. Once the money is tied up in an annuity, it is made purposely difficult. I would argue it's made purposely difficult to retrieve it. There are hefty surrender fees charged by the insurer to get the money out of the annuity before a period of time has come. It's usually 6 to 8 years, but it could be even longer. So the money is going to be tied up and they're going to make it difficult for you to get it. There's going to be penalties. There's also tax penalties for early withdrawal. So that's something to consider. Annuities already are tax sheltered. This is important to remember. Therefore, it's redundant, and there's no additional benefit to put them in an IRA, despite the salespeople who may be very insistent or eager. They want that commission. So just be very careful that you don't need to put the annuity in an IRA because it's already tax advantaged. Annuities should only be considered by those with straightforward finances that desire simple and fixed payments. Annuities are not necessary for everyone, despite what the salesman may tell you. But they are probably one of the most established ways to save money and get an income stream for retirement. It's critical to evaluate all possible fees associated with any financial or insurance product you are considering. Be very careful. This is your money. You may have worked your whole life. You probably did work your whole life for this money. So be very careful how you invest it so that it can provide for you at the end of your life. There are alternatives to annuities, including deferred compensation plans like 401ks, IRAs, dividend-paying stocks. They were saying on the business hour on the radio that dividend-paying stocks are very cheap right now. On a side note, international stocks are very cheap right now too, but those are going to be a little bit riskier, probably quite a bit riskier than U.S. domestic dividend-paying stocks. There's variable life insurance, and there's retirement income funds. So just be very careful with annuities, and again, just be very careful with the salespeople and the commissions. You have to really consider what people's self-interests are.